You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplified ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Soueidan once again. He was here last week as well to talk about KTEL. Today's here to talk about one more stock, PXHI, Phoenix Holdings. So, number one, thank you so much for being on the podcast once again. And and thanks for coming on to discuss, about PXHI and, share the opportunity to our listeners.
No, well, thanks, man, for doing this again. This is my favorite part about doing these kind of things is actually in the end the stock pitches and stock picks and learning from others about their ideas and sharing mine if anyone cares to listen. Sometimes it's not worth it, but so this is exciting. Thanks for having me back.
Awesome. So last time KTEL was what you called an information arbitrage play. So is this pretty much the same kind of stock pick as well?
There's some of that in there, yeah. So again, information arbitrage is just for a quick thing is just looking at information that's out there in public filings that's not and conference call transcripts that's not really in press releases. Just information, and it's the easiest way for beginners and really any level investor to really start creating an interesting pipeline of companies.
Yep.
Maybe want to take a look at, and this one has a little bit of that. This is more of really, I think people ignoring the information really in press releases and stuff.
Got it.
Yeah. So. But,
well, awesome. So like last time, he's going to allow you to speak, about the stock, just share your thesis. So, yep.
Okay, great. Thank you. And again, I own the stock. So, full disclosure there. And I started buying the stock PXHI. It's Phoenix Holdings. It's like the stock has gone through a bunch of name changes since 2008 or 9. And, really I came across the stock in 2000, I think it was 19, at around, let me see here, around 30 cents. And, I do a lot of screening for like new highs, momentum. I look for momentum and value. And this I think this popped up on one of a new high or something. And I noticed that, it's a pretty good earnings report or something like that. They were at that time, they were not filing, where they still aren't on the SEC. They were on the OTC markets. And look, so this company really, what they do, they got two pieces of the business. One side is like this buying through their subsidiary called We Sell Cellular, which I'm going to get into in a second. Buys used cell phones, takes possession of them, and then sells them to wholesalers, retailers, or other kind of enterprise customers that would use the phones. And then they also have a platform where allows, well, actually we sell. Let me back a second. So we sell those phones, mainly through this platform that they have, and they also license the platform to other either similar companies, wholesalers, or other companies that buy used phones and sell them. And so they basically take possession of the phones, sell them directly through their sales force, sell them through their online portal, or they license the software for the portal for other companies to white label their own kind of business onto that, actually. So that's basically what they do right now. And the evolution of how they got there is pretty interesting. That's not how the company started, actually. So Nick Rahman is the CEO of the company right now, and he developed this platform. I interviewed him one time in 2019 I was actually at an LB, I think, microcap conference, and I was trying to get a hold of him. He called me. I was in a hotel room. I took the call, talked to him for like a half hour, actually 45 minutes, and he's been through a rough time with the market, so it wasn't an easy conversation, but I learned a lot about the history at least and how the business worked, which is what I wanted to learn, and I took a bet on it. And at that time, when I found it, the company was kind of turning around or kind of reached some type of, I guess, small inflection point in a turnaround story. So if you go back to the company in 2008 or 9, I guess it was, it was I think called Cash for Gold. I forget what the symbol was, but so at that time Nick was uninvolved with the company. They were selling,
He's on the board of the company.
He wasn't even on the board. No, he wasn't even involved yet. He was still in college at the time. He was coming out of college, and at that time, because this went public through a reverse merger with Nick's assets eventually. But before Nick was there or his assets were there, it was a company was called Cash for Gold, and that management team was running the company as like they had their own. I guess they had a platform where they were just mainly doing, buying jewelry, for example, reselling it, or breaking it down and selling the raw material, the raw gold or whatever, or silver. That's what the business was, and then it evolved into like doing electronics and phones. And I think what had happened was, even before Nick got there, they saw this opportunity to do this with the used phones, but they were doing with the used jewelry, right? And what's natural extension, I guess. And I think for a while they were using Nick's technology or licensing it before Nick came on the company. And then a few years later, I have the timeline here, I think somewhere here. Give me 1 second. Yeah, 2012. So 2012, I think they consummated this reverse merger with Nick's company. So Nick had developed a platform while I was in college. And so the problem, even though it was an interesting thing, and Nick claims he was the first one doing this at that time. And at that time, it was still asset heavy. They were just, so they would basically, well, they started, I'm sorry, asset light, then asset heavy. So this is very interesting how this happens. So Cash for Gold was this asset heavy site, right? Where you come in, they take possession of it. Then they went to this, they decided, let's go with this asset light model with Nick's platform, where consumers would come to the platform, list their phones on the platform, and the platform would match them with enterprise buyers. That's how it worked. And they didn't take possession. Now the reason that was I think they decided to do it that way because previous to the phone model, where all management was taking possession of inventory after themselves, and even though they were growing the revenue, they couldn't make money in it because you had to spend a lot of money on the inventory, right? As well as marketing to people to come to your website. And they were spending, I think, 90% of the revenue was going towards marketing people to the website, and then you add on top of that having to purchase inventory sometimes too, right? So it became wasn't a sustainable model. So then they thought, all right, we'll bring Nick in here, and so it started with this basically still consumer-driven model, whatever it was, and they decided, eventually that this model, which was still producing revenue and they were growing revenue, and I think they got to maybe $6-7 million doing this. When Nick came in, I think they were at 2 or 3 million or something. Then they said, you know what? We still can't make money. We're still spending a lot of money driving traffic here to the website. What's going on? Because it was still a consumer model, really, when they did it with Nick originally. And then that caused a whole host of problems too, because the key to selling used phone business is that you need access to constant supply, reliable supply. So now you're basically banking on consumers to do that for you, right? For the buyer, the other side, right? So on this model, PXI would receive a fee up front. So a consumer will come on the site, find a buyer through the platform. At that second, PXI will get a referral, what you want to call it, a listing fee or whatever at that time. So when we look at this model now, there were a lot of things wrong with it. So as it was at that point, especially, so you take a look at the way the fee was earned. So you had these quality control potential issues. So what would happen was, consumer would come on there and make a deal with a customer, maybe a wholesaler. Wholesaler gets it, doesn't like the quality of the phone, right? And then eventually pays the consumer less for that phone. So you have an unhappy consumer, right? Because you got less than they agreed upon. You kind of got an unhappy buyer because they got less of a quality phone. And that buyer still had to pay the same fee that they originally agreed upon, right? So this wasn't really conducive to a great model. So they changed the model a little bit over time. So Nick basically, along the way, when Nick didn't really take over CEO until a few years later, the all management team was not running the company properly. Right. So losing massive amounts of money, massive. And a lot of it, they thought maybe it was this whole, how do you like balance this, right? You need quality control, right? But you also have this marketing expense. This is crazy. So how do you balance that? And so eventually they decided, the quality control was more important at that time, I guess. So they said, let's go and let's just change the whole business model. Let's not market to the consumer anymore. Let's just become the wholesaler. Let's just go out there and buy phones ourselves. So he tried doing that, right? So now they're back all of a sudden to an asset heavy model, right?
Mm-hmm.
But he thought because of the platform and the efficiency they had with that, they could make money doing it.
Right.
But didn't quite work out that way. So they've lost on what they gained from having no marketing, like a light marketing expense, they lost on the gross margin on that kind of model. You're taking all this inventory and that risk too, right?
Mm-hmm.
And so they decided, okay, well, what can we do now? And the good thing about, by the way, taking control of the phones was that they could, ensure quality, theoretically. So they would get the phones and then send them to some third party partner who would inspect the phones and put quality of the phone before delivering it to the buyer. Now again, at that time they were really they had transitioned again from the consumer model to the enterprise customer model, right, over time. But they said, okay, well, to basically do it this way, the way they were doing it, it's still going to take them a long time to get where they had to get the scale of, they weren't born in this industry of the model of purchasing cell phone inventory from consumers or even enterprise customers. That's where the volume was, right? From other wholesalers. So basically, but when trade-ins come in, all the supply of phones become available, right? Or when new iPhone models launched, you have the trade-ins, and all this used inventory becomes available, right? So
Yep.
How do you get access to that supply, right? And buying it from the consumer isn't going to do it. Cut the cake. Buying it from the enterprise customer, you have to get a relationship. It's a pretty shady industry in some respects. So it takes a while to get that, to build that reputation and build that scale. So they went and bought out a company called We Sell Cellular, and I think they were doing about 80 million in revenue. This is versus like a revenue base at that time for them, I think around maybe 8 million or so. I think they got as high as actually 15 million on the old model. So what We Sell did, that's what We Sell had done. We Sell was a purely, they would just go out there and buy cell phones, use cell phones from other wholesalers, phone companies, or retailers, based on trade-ins, whatever like that. And then they had a sales force who would directly sell them, to the other enterprise customers. So that was interesting, but again, you have this asset-heavy kind of approach, which is okay because at least they could ensure the quality, but you had to still pay your sales force and direct sales force to go out there and sell the phones. So you had to find, and it's a lower margin business too, right? When you're just buying these phones, the used phones and doing it this way. So what they ended up doing was, I said, well, okay, well, we can't sacrifice the quality because we have to inspect them. We Sell Cellular would inspect the phones. You buy them, inspect. They have their own warehouses and everything, so they wouldn't have to at least put in a third parties. So they saved on that because the old model they were doing previous to that, they were actually had a third party partner had to give us that margin away.
Right.
They solved that problem at least, but it's still asset heavy. And how do you basically start making money off this business? they said, well, you know what's wrong with us? Let's start selling these phones through our platform that they already had. They had the platform. So they just took resell cellular, right? And they stopped really over time with the direct sales force approach and started putting them on the platform. This happened about, that change in that model was between like, I think 17 to 19 area. And I think 19 is where it really started to pick up, which I luckily just found a stock at that time. So now it became, you had this asset heavy combined with the asset light type of approach, right? Which so they were able to make money doing it. And they turned a profit for the first time around that time when I was looking at it, and they've been profitable ever since. And then along the way, they're like, you know what we have here is pretty good. It's the platform, the technology, software that kind of powers it. Let's license it to other wholesalers, and just all these, and anybody else who's in this kind of like industry. And they started doing that in 2019 when I found them with this company called Brightstar. And Brightstar is a really big, one of the leaders in this, like buying used inventory from and trade-ins from like retailers or phone companies. And not only was that relationship interesting because of Brightstar was going to use the platform, but it also became a nice source of supply for their resell cellular, for example. So that's how it evolved. And what was interesting at that time when I had found it was there was a kind of an 8K buried in the file, the SEC.gov, which talked about a option that this is a little informational arbitrage, I guess, that Brightstar also had this option to buy the company. And they didn't really list the details of the whole agreement, but what was important about it, we're going to come up to in a second, why it was important, was that if Brightstar was to buy PXHI, they basically had to be, debt-free and no encumbrances. And along the way here, because the PXHI was losing money, they had to raise a lot of dilutive capital. They put some debt up, some convertible debt, so they had a messy balance sheet. And along the way, which I was impressed by the way, Nick was actually helping to fund the company to keep it alive. He believed in the company. So I thought that was interesting. That led me to believe that I didn't really do any facts and check on the technology at that time, and their position. Hey, Brightstar is one of the leaders in this industry, and they're willing to, potentially maybe buy the company. Who knows? So that's kind of what got me really interested. Was what I really wanted to know now is I wasn't really interested in, even though the resell model of buying the phones and putting them on the platform was interesting. I still don't like the asset heaviness of that and having them be, still having to take control of the inventory and everything. Yep. I was more interested to see what would they do with the licensing side of the model over time, right? And that's what I want to see. And fast forward to today, the company is, hasn't been growing revenue that fast, but they've been staying steady. But they're, I think right now really concentrated on scaling that licensing business. And I think they got another customer actually, and I think they're really going to go after that market now, and try and really aggressively pursue it. They're not really, they don't tell you much about their clientele. They're on the OTC. They do put some nice filings in the OTC market, but they really don't break down the business between the revenue and the margin stuff. So I don't have a great idea on what the margins are on each side of the business and what the size are of each side of the business anymore. But they're becoming more profitable. And the stock now is like $1.65 or something. We wrote an article on it a few weeks ago, actually, for Geo, for our premium members. The stock, I think, was around 50, 60 cents then. And since it's gone up, so it was interesting during that. So you have this, now I think they have the perfect blend of a market. They have the resell cellular, which has an asset heavy but asset light piece to it. And now they're going after really scaling the pure licensing model. If that really works out, there's a huge, I think, opportunity for valuation expansion. If it works out, obviously, right?
Yep.
And so what are some telltales? I mean, other than that, so the company has been very communicative with, investors. They're not really out there talking to investors or going to conferences, virtual or even brick and mortar before the coronavirus. So a lot of our, research has to be done in the filings and kind of, getting tells from management, clues. So I got really excited about it progressively over time. But then a few weeks ago, they put out a press release that they're basically paying down all their debt, approved the buyback program. And part of that debt payback was two things: was a line of credit, which they paid it all down, and they put out a early conversion notice to the convertible note holders, and they've all basically decided to really convert to stock. I thought that was pretty bullish. So you have a little bit of dilution, but it was even with the dilution, you figure out at that time it was selling at under I think a 0.3 or 4 EV to sales, something like that. It was crazy. That's pretty interesting. So, and then what I found really crazy was they actually closed their credit line. They can keep it open. Like, why would you close? Why would you not keep it open? You know. So he's telling me one of two things. He's so confident that the business is about to grow here quickly, right? Or they're going to get taken over. And remember, if you go back to the the Bright Star relationship,
They have an option to buy it.
Right, but you had to be debt free basically. You know, so, and that was part of what no encumbrances. So, look, there haven't been any updates since 2019 regarding the Bright Star relationship. So I don't know if it's still there. There was some exclusivity option onto it, but now I know the company has actually been onboarding other customers to their platform, the licensing model. So I don't know if that licensing, the buyout's still there or if it's expired, but regardless, there's some really positive move by management. And secondly, in the last press release, they put out, hey, we want to buy your stock, so sell it to us. You know, so all these things are pretty interesting, which tells me that he must know that they have something good lined up here, right? But regardless, I mean, they've been showing that they've progressed in 2019 and 20, and now 20. They had a good first quarter of 21. If you do if you look at the math or the valuation, I think it's selling at a PE of around 15 or so now. You know, I could see that PE doubling, and that's just on the trailing. If you do a current run rate, you get a much higher kind of valuation. But I'm looking at this more of on a revenue basis. You know, if they're at 100 million revenue run right now, I think prior to this they're about at 80 million run. They did 80 million, I think, for 2020, and just on Q1. Run rate's a little tricky because there's just some seasonality to the business, so you got to be doing that.
Right.
There's a big whenever there's like a new rollout of iPhones, for example, that's when a lot of inventory becomes available, and they can and that's when, and we're coming up to one, I think, in August here. And that's all, by the way, that's also the risk of it. If there's a delay in a launch, that means no inventory comes. You know, you don't get a used inventory that you're expecting. So there's the delay to your growth probably. So when you have these delays and a delay in a launch, consumers aren't buying phones because they're, you know, the used phones, because they're waiting for the new one to come out so they get the, you know, the greatest model, right? That on the trade-ins and stuff. So that's the risk. But it happened one time in 2014, the company got just destroyed. They bought We Sell Cellular, and then almost immediately there was a supply chain issue plus a delay in a rollout on one of the iPhones. So it caused a really big disruption, which is another reason they want to go to a licensing model. You know, because they don't want to deal with a lot of that too. They want their customers, they want their, you know, let other wholesalers deal with it. You know, they don't want to deal with it. So that's another, and as they do that, and they're de-risking the company, you should get valuation expansions there too. So the EV to sales right now, I think maybe about, you know, it's maybe about 0.6 or something now still, or 0.7 maybe. When we wrote the article, let's see this. Let me check here. I got the stats here in front of me. Give me a second, man. My computer's acting up.
And no problem.
Yeah, so it was a EV to sales of 0.55. That's the stock was $1.09. It's kind of, you know, now it's $1.60, so it's gone up obviously. But you know, you take a situation where the more and more. Now, by the way, all my numbers are fully diluted basis because there's 23.7 million. Actually, 28 million out basic, and there's about 44 million diluted. So I'm assuming full dilution. That's how I do all my valuation on full dilution, and that's based on the convertible notes being converted. which I just announced. So I'm assuming that's going to be about the number. So you got to think now. You have these kind of valuations, which might be appropriate for the asset heavy balance sheet that they had, right? And with debt on it. But now, if they can get to this more of a licensing model,
Yep.
you can see a significant expansion in the valuation, to maybe these EV to sale numbers with a 4 to 6 range or more. And PE isn't going to matter as much. But what's really interesting too is the current model. If you look at the first quarter revenues, I think increased 30% to I think it was like 27 million or something. The operating expenses went down, so they have a really good operating leverage. I see at 26 million. They were 26 million for Q1 versus 19.7, and SG&A operating expenses were down. So you have obviously this. It looks like if they can continue to increase revenue, they reach a point where a really nice leverage here, where a lot of that revenue is going to fall to the bottom line. The gross margins are really thin right now still, which leads me to believe that most of the revenue still is still coming from the we sell cellular as a heavy. I think they're around 13 or 14% gross margins.
Yep.
But if so I don't know what the licensing rep now. There's a little information arbitrage here too, because in the filings they did announce that they signed a new licensing partner. They didn't say who it was. They haven't put that in their press release at all yet. So that should be coming up soon here, maybe Q2 and Q3. Hopefully we'll start getting more color on the gross margins of that business, but you got to think it's going to be higher than the 13% they're doing on the wholesale business. And you get this double whammy effect. You're de-risking the balance sheet, right? You're increasing the sexier part of the business and the more recurring part of the business, or at least predictable, less risk to that one too. So that's why you get the magical moments where you can have really a lot of things happening at one time, and a massive increase in the stock price if they converge to translate to revenue and EPS growth, which I'm hoping they do here. So and the industry itself is a huge industry that it's going to grow for. It's actually you have with these, there's a desire for of course self-ownership and having and doing trade-ins. You have a predictable kind of trade-in pattern every year, right, with Apple and stuff.
Yep.
So it's really interesting. If I pull some stats here, I think I have some nice. Although I'm getting my first iPhone soon, so I'm gonna be part of the iPhone nation soon, by the way.
Yay.
Let me see here. Yeah. What's going on here? Huh. I don't know what happened over here, my friend. I had some industry stuff here in front of me, but I think I might have lost it. Give me one more second.
Yep, no problem.
Wow. Yeah, well, I guess I don't have it here.
All right, no problem.
Yeah, so we'll have to move on. Yeah. But anyway, so that's really the story in a nutshell, man. And I think that I'm hoping that the company's going to want to list soon. Go to a major exchange. I mean, they used to be listed, before they ran these problems. After they bought WeSell, and they had the problem with the whole supply chain risk thing. I think they just went dark for a little bit to get things to cut costs and get things going again.
Yep.
And I think I wouldn't be surprised to see them try to uplist again to the NASDAQ, or maybe I don't know, Amex NYC. I don't know where they would go, but and I think really the acquisition still is on the table too. I mean, we can't say that for sure, but it seems to me that that's still going to be an option on the table for them.
Got
That's it,
it.
man. So I have, we have a full report on this thing on GeoInvesting. If anyone's out there interested in learning more about the company, we can share that report with you. If you just email me at maj@geoinvesting.com or support@geoinvesting.com. And of course, you can go to geoinvesting.com and try us out we have a free trial, like a 7-day free trial. So that's it, man.
Yep. Well, yeah, awesome. Thanks for sharing your thesis, Maj. It's always great to pick your mind on what opportunities you're seeing in this crazy market. So awesome. Thank you for coming on.
No, thanks. We'll do it again soon.
Yep, absolutely.